Hello everyone. Today I will talk about interest rates. There are three concepts I want to cover today: the simple interest, compound interest, and APR, annual percentage rate. First, simple rate. Let's first look at what is interest rate. It is the cost of using someone else's money. If you borrow money, you have to pay back the amount borrowed. Sometimes we call it principal, plus the interest you owned. If you lend money, you will get your money back plus the interest. For simple interest, if you lend someone $100 and you'll be paid 7% simple interest, then you will receive $7 in the interest payment for each year that the loan is outstanding. Here is an example. You can see first year, 7% of $100, you get $7 as interest payment. Same as the second year, you get $7. Third year, you get $7. The total is $21. Here is another concept. When will this $21 be paid to the loan's owner? Here, if they paid it annually or even sometimes monthly, they call it current interest. If they do not pay it right away, but allow the borrower to defer or wait to make the interest payment until the end of the 3 years, so you pay the $21 at the end when the $100 loan is due, this is called accrued interest. Now let's move on to the compounding. What does this mean? For compounding, it will take your investment returns and also turbocharge them. So by giving you interest not just on the $100 you lent to the borrower, but by requiring the borrower to pay you interest on the unpaid interest as well. We will have an example later. Generally, in this case, the borrower has to pay extra for not paying all the annual interest that is owed each year. For this example, you can see the first year still the same. You pay $7 in interest. For the compound in the second year, they calculate the 7% based on the 107. That is $100 principal plus the $7 interest from the first year. So the total interest rate you have to pay for the second year is $7.49. For the third year, you end up all the principal and the unpaid interest together. That is 7% of $114.49. So the total interest for the third year is $8.01. So overall for the 3 years, the compound interest rate now is 22.5, which is much more than the $21 from the simple interest calculation. Now let's move on to the APR, annual percentage rate. For the same $100 you get borrowed from the bank, they said they will charge you 5% interest rate. But is the total cost of a loan just $5? Sometimes yes, sometimes not necessary. There may be some hidden cost there. For example, if the interest rate is calculated 5% for the whole year, or they have some compounded over a course of the year. So if they compound like semi-annually or they compound monthly, then that will, in the end of after a full year, you will get totally different interest rate. And also some people of the loans, they will charge you fees and some additional cost to this transaction. So API is a very good way. It let the loan disclose the all-in cost to finance or borrow the money. So it's provided the consumer with a bottom line number they can compare among different lenders, like a car dealer, banks, credit card, investment product. So this is different. APR usually it will be higher than the interest rate itself because it may be considered the cost, fees, and the different compounding method there. Overall, today we covered the interest rate. We talk about the simple interest rate, the compounding, and APR. What's the difference there? Hope you like it. Thank you for watching. See you next time.